Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Navitas Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath. And also, check out the VIP Algos link down below in the description.
Yeah, it's a great tool for tracking market momentum and spotting those technical setups.
Highly recommend it. So today, we are tackling a little-known semiconductor stock that is up an eye-watering 227.5% so far this year.
Which is just wild.
It is crazy. They are single-handedly beating both Nvidia and Broadcom in 2026 performance, which almost sounds impossible.
Right, but our mission today is really figuring out the why behind that massive surge. Because, Navitas isn't designing those glamorous AI chips that write your code or generate videos.
Yeah, they aren't doing the actual thinking in artificial intelligence.
Exactly. They're building the underlying hardware that stops these massive AI data centers from just physically melting down or running out of power entirely.
So over the next 15 minutes or so, we're going to examine this really radical business pivot they made.
And we'll dig into the actual physics of their technological moat, too.
Yeah, and then, because we definitely have to stay grounded here, we're going to weigh all of that immense potential against a valuation that, quite honestly, looks a little terrifying right now.
Oh, absolutely. I mean, to truly understand the hype surrounding Navitas today, we kind of have to rewind just a few years.
Right.
Because they were not born an AI darling. If you looked at their business model a little while back, you would have seen a company focused almost entirely on low-margin consumer mobile applications.
Basically just phone chargers, right? Like fast chargers for your laptops and everyday consumer electronics.
Yeah, exactly. A high-volume business, sure, but incredibly cutthroat. The margins are super thin, and, consumer tech is just notoriously fickle.
Right. But then they pull off this fundamental shift. They step away from consumer tech and dive headfirst into enterprise data centers.
Specifically targeting AI infrastructure, which is a whole different ballgame.
Yeah, looking at their history, it honestly felt like watching a company that mastered the plumbing for a tiny backyard garden fountain, suddenly pivoting to build the high-pressure water mains for the Bellagio fountains in Vegas.
That is a great analogy.
Right, because it's still technically moving water, but the pressure, the scale, and the catastrophic consequences of a leak are just exponentially higher.
Oh, for sure. The margin of error goes from, a mild annoyance that your smartphone is charging slowly.
Which is annoying, but fine.
Right. To an absolute disaster where a billion-dollar data center literally catches fire. It's a staggering lead in complexity.
And yet, looking at their Q1 2026 financials, they are actually pulling this off.
They really are.
They posted $8.6 million in revenue, which beat analyst estimates of $8.18 million. But the headline number isn't even the overall revenue.
No, it's the internal shift.
Exactly.
Yeah.
Their high-power market segment expanded 35% year over year. And even more impressive, the specific AI infrastructure subsegment rocketed 50% just quarter over quarter.
Which is huge. I mean, Wall Street looks at a 50% sequential jump in the exact sector every major tech giant is currently pouring money into.
And that's when the stock price goes completely parabolic.
Yeah. That kind of quarter-over-quarter growth proves they aren't just announcing their intentions,
Yeah.
They are shipping actual enterprise products.
But the obvious question when you look at those numbers is, how does a former consumer charger company manage to build a technological moat strong enough to win enterprise AI contracts?
Right, it's a huge jump.
Yeah, and their filings point to something called a dual technology platform. They brought two next-generation materials under one roof.
Gallium nitride and silicon carbide.
Yeah. Gallium nitride, which they use in their proprietary GaNFast FETs, and silicon carbide, which is used in their high-voltage GeneSiC technology.
So let's break down why those two materials are the absolute secret weapon here. Because for decades, the entire semiconductor industry has basically run on traditional silicon.
It's cheap, we know how to manufacture it, it works great for your standard laptop.
Exactly. But traditional silicon has hit a physical brick wall when it comes to managing the intense power loads required by modern AI.
Because it just leaks energy, right? It gets way too hot when you push massive amounts of power through it.
Spot on. And that's exactly why the industry has been desperately looking for alternatives. Gallium nitride, or GaN, and silicon carbide 6 are what physicists call wide bandgap materials.
Okay, so without turning this into a high school chemistry lecture, what does that actually mean?
Fair enough. Essentially, The atomic structure of these materials allows electrons to move much faster,
Okay.
and they can handle significantly higher voltages without leaking all that energy as heat.
So the band gap is essentially the hurdle an electron has to jump over to conduct electricity.
Yes.
And a wider gap means the material can operate at much higher temperatures and voltages before the electrical current just bursts through where it shouldn't.
You nailed it. Traditional silicon just breaks down under the stress of a massive AI server rack. But GaN and SiC can handle massive voltages. They can switch on and off at blistering speeds, and they do it all while generating a tiny fraction of the thermal waste.
That makes total sense. And just to clarify a piece of jargon from earlier, those GaN fast FETs, a FET is just a field effect transistor, right?
Right, which is really just a microscopic switch that controls the flow of electricity.
Okay, so Navitas has figured out how to make those switches out of gallium nitride so they operate at speeds traditional silicon simply cannot physically match.
Exactly. And they didn't just stumble into this capability overnight. They've protected this dual-platform approach with over 300 issued or pending patents worldwide.
Which is incredibly rare, isn't it?
It really is. Most semiconductor companies specialize in either gallium nitride or silicon carbide. Or, they treat these advanced materials as just a tiny experimental division within a massive legacy silicon business.
Right, they hedge their bets.
Yeah. But by holding patents in both and focusing exclusively on power efficiency, Navitas became a true pure play on solving the power bottleneck for the entire data center chain.
And that proprietary technological moat perfectly positioned them for what is undoubtedly the biggest market catalyst of 2026.
Oh, absolutely. The Nvidia partnership.
Yeah, they secured a direct integration into Nvidia's AI Factory MGX ecosystem, which was formally showcased at Computex 2026.
Which is huge. I mean, being integrated into Nvidia's ecosystem right now is the hardware equivalent of being handed the keys to the kingdom.
Definitely. But you still have to build something the kingdom actually needs, right?
Exactly. You can't just show up empty-handed.
And what Navitas built is fascinating. The crown jewel of this partnership, the product that really sent the stock flying, is a 20 kilowatt, 800 volt to 6 volt DC-DC power delivery board.
Which is a mouthful.
It really is. But I want to pause on the engineering specs for a second because the technical achievement here is super specific. They claim this board completely eliminates the traditional 48 volt intermediate bus converter stage.
Right.
So if I'm understanding this right, that 48 volt stage is essentially a middleman. And in physics, every time you hand off electricity from one stage to another, you lose some of it as heat.
That's exactly right.
So are they just bypassing the middleman entirely?
They are completely bypassing it. And to understand why that's so revolutionary, you have to look at how data centers have historically been built.
Okay.
So power comes from the municipal grid into a data center at a massive voltage, say 800 volts. Think of it like a fire hose of electricity.
Right.
But the actual AI chips, the GPUs, they operate on a tiny fraction of that, usually less than 6 volts. Like a garden sprinkler.
And you can't attach a garden sprinkler directly to a fire hose without blowing it to pieces.
Exactly. So you step it down. For years, the industry standard was to step the power down in stages. You go from 800 volts down to a manageable 48 volts.
Okay.
And then you distribute that 48 volts across the server rack, eventually stepping it down again to the 6 volts the chips actually use. That 48 volt stage is just a legacy holdover from the old telecom days.
But the problem, like we established, is that handoff. Every time you step the voltage down through one of these converters, the inefficiency bleeds out as heat.
And heat is the absolute worst enemy of an AI data center.
Right, because heat means you have to spend even more electricity to pump in chilled water, run massive air conditioning units, just to remove the waste heat generated by simply moving the power around in the first place.
Exactly. It's a vicious cycle. But by utilizing their proprietary silicon carbide and gallium nitride tech, Navitas figured out how to safely take that 800-volt fire hose and step it directly down to the 6-volt sprinkler in one single hyper-efficient move.
Wow, so no 48-volt middleman, which means no secondary loss of heat.
The results they demonstrated at Computex were just staggering. By eliminating that handoff, this new board achieves 97.5% peak electrical efficiency.
Meaning almost none of the power is wasted as heat?
Exactly. And because they don't need to physically house all the bulky capacitors and components required for that middle 48-volt step, they shrink the physical footprint of the power supply dramatically.
So they are hitting a power density of 2,100 watts per cubic inch.
Yeah, which is insane.
So they're shrinking the footprint of the power supply while maximizing the output. That lets data center operators cram even more GPUs into a single server rack without the building catching fire.
It is effectively the holy grail for AI infrastructure right now.
It really sounds like it. But, solving that bottleneck in a lab or even for a showcase at Computex is one thing. Scaling the manufacturing to actually meet global enterprise demand is an entirely different beast.
Oh, absolutely. And it requires a massive mountain of cash.
Which brings us to the financial reality check, because it is not all sunshine and Nvidia partnerships here.
No, it definitely isn't. The transition from manufacturing small consumer phone chargers to enterprise-grade AI infrastructure is incredibly capital intensive.
Right, retooling factories, funding heavy R&D, scaling up production lines.
It burns through capital fast.
And that burn is highly visible in their Q1 report.
So let's look at the ugly side of the ledger for a minute.
Let's do it. They posted a GAAP earnings per share loss of 15 cents, which was significantly worse than the 5-cent loss Wall Street analysts had estimated.
Yeah, that was a mess.
And their GAAP gross margin is currently sitting in negative territory at negative 9.3%.
Right.
Plus a non-GAAP net loss of $13.8 million. They are burning through cash while generating only $8.6 million in revenue.
Yeah, a negative 9.3% GAAP gross margin is a really tough pill to swallow. I mean, it literally means that under standard accounting rules, it costs them more to manufacture and deliver their products than they are making from selling them.
Yikes. Now, they do have a lifeline. They are sitting on $221 million in cash and cash equivalents, and they carry zero debt.
Which is great. It sounds like a solid runway.
It does. However, they just launched a $500 million at the market, or ATM equity program, in June.
Yeah, and that's a big deal.
Right. For anyone unfamiliar, an ATM program means the company can slowly trickle up to 19.9 million new shares into the open market to raise that $500 million.
Which directly dilutes the ownership stake of every single current shareholder.
Exactly. And ATM programs usually trigger a negative reaction because of that dilution risk. It caused a sharp 6.7% single-day pullback in the stock.
It did. But, you have to peel back one more layer to see why Wall Street institutions aren't just running for the hills entirely. You need to look at their non-GAAP gross margin.
Okay, because the non-GAAP numbers strip out those one-time transition costs, stock-based comp, and the heavy capital expenditures of retooling the factories, right?
Exactly. And when you strip all of that out, their non-GAAP gross margin is actually a very healthy 39.0%.
Oh, wow. Okay.
Yeah. So what that tells an institutional investor is that the underlying unit economics of the chips themselves are totally sound. The actual raw cost to manufacture a finished GaN or SEEK chip versus what an enterprise customer pays for it is highly profitable.
Right. So the massive losses you're seeing on the GAAP side are mostly just the transition costs. It's a cost of building the factory, essentially, not the cost of making the widget itself. But wait, building the factories and aggressively transitioning the business, yes, their entire business model right now.
Sure.
So if we strip out the cost of them physically building out the company's capabilities, aren't we just looking at a fantasy number? Let me push back on this valuation for a second.
Go for it.
Because the stock is up 227.5% and is now trading at roughly 92 times sales.
Which is steep.
Very steep. Its historical 5-year average is 11.8. So you throw in the heavy share dilution and, the fact that one of their directors, Dr. Ranbir Singh, abruptly resigned in early June without much explanation.
Yeah, the timing on that wasn't great.
Right. So I have to ask, are investors blinding themselves to these red flags? Is the market just pricing in absolute flawless execution for a company that is still losing money while building its foundation?
I mean, that is the exact tension every growth investor has to wrestle with here. Yes, 92 times sales requires pricing in a near-perfect future. There's no getting around that. But the counter-argument is the sheer scale of the total addressable market, the TAM. If you have the technological lead to become the foundational power architecture for the next 10 years of AI, you don't penny pinch to save your GAAP margins today.
You just go all in.
Exactly. You authorize the ATM program, you raise the $500 million, you take the dilution hit on the chin, and you scale your manufacturing as aggressively as physically possible.
Before a competitor figures out how to replicate your 800-volt direct step-down board.
Exactly. So the dilution is just the toll they have to pay to get onto the highway before someone else takes their lane.
That makes a lot of sense.
It's a necessary maneuver. In the semiconductor industry, if you win the design phase but can't manufacture the chips fast enough to meet the client's timeline, they will literally just move to the next supplier, even if the tech is slightly inferior.
Because time is money.
Exactly. Navitas is raising cash to ensure they don't bottleneck their own clients.
And it seems like the institutional analysts agree with your assessment of that long game.
They do.
Despite the eye-watering 92x sales valuation, despite the cash burn, Wall Street is aggressively resetting their targets higher.
Yeah, the upgrades have been pretty steady.
Right. Morgan Stanley recently raised its price target on Navitas from a mere $4.20 all the way to $12.50. And Baird came in and raised theirs to $20.
Which is a huge jump.
It is. For context, the stock is currently trading around $17, having bounced off a 52-week low of just $5.44. The analysts are actively revising their revenue models higher by 10% to 20% for the next 3 years.
And everyone is heavily focused on the upcoming Q2 earnings in August.
Right, the next major catalyst.
Yeah, management guided for $9.5 to $10.5 million in revenue. They hit the top end of that guidance. It basically proves the sequential growth engine is real and that enterprise adoption is actively accelerating.
But, solving the heat issue inside the server rack might only be half the battle here.
That's true.
If you pull back the lens, the next massive bottleneck is the power grid itself, which explains why there is a speculative, unconfirmed rumor growing in the market right now that Navitas isn't just stopping at the data center power delivery board.
Right. There's a lot of chatter about them moving beyond the server rack and into the actual municipal infrastructure.
Yeah, exactly. The rumor suggests Navitas is positioning its 250 kilowatt solid-state transformer technology for direct grid-scale infrastructure contracts.
That would be a massive pivot.
Huge. They are supposedly working directly with top-tier hyperscalers, meaning the massive cloud providers beyond just Nvidia, to manage the power coming straight off the city grid before it even enters the building.
Wow.
And the financial models suggest this specific move could unlock a $1.8 billion serviceable market by 2030, which is way faster than anyone originally modeled.
But it makes complete logical sense when you look at the trajectory of AI, right? First, we didn't have enough chips, so companies like Nvidia built them.
Right.
Then we couldn't power those chips efficiently without melting the servers, so Navitas built the 800-volt to 6-volt board. But if you look out to 2028 or 2030, the bottleneck becomes the actual city electrical grid itself.
Because these hyperscale data centers are drawing gigawatts of power.
Exactly. They are requiring entire power plants dedicated to a single facility.
That is just mind-blowing.
And traditional grid infrastructure like mechanical transformers, old-school circuit breakers, they just aren't designed for the massive dynamic loads of an AI data center turning on 100,000 GPUs simultaneously.
They are slow, inefficient, and prone to failure under modern loads.
Right. So by developing 250 kilowatt solid-state transformers, Navitas is essentially saying, we solve the power flow inside the server. Now we're going to solve the power flow outside the building.
And there's actual financial movement to support this rumor, too.
Oh, really?
Yeah, Navitas recently participated in a $17 million strategic investment in a company called Alpsemi.
Okay, and what do they do?
Alpsemi specializes in scaling solid-state circuit breakers, specifically for 800-volt DC data centers.
Okay. That is a huge tell.
Right. This fundamentally shifts the entire narrative around the company. It means Navitas isn't just an AI server component play anymore. They are actively evolving into a macro-level grid power company.
They are trying to own the entire journey of the electron, from the moment it leaves the municipal grid to the moment it hits the Nvidia GPU.
Which is an incredible ambition. So let's synthesize everything we've unpacked here for anyone trying to make sense of this stock today. We have to clearly weigh the upside and downside.
Definitely.
Navitas is undeniably expensive. At 92 times sales, with heavy cash burn and an active $500 million share dilution program hanging overhead, the stock is no longer a cheap, undiscovered gem.
No, the secret is definitely out.
Right. It represents a classic high-risk, high-reward play.
It absolutely requires a multi-year hold mentality. We can't give explicit advice, obviously, but if we're looking at a bullish score for the long term, I'd probably put this at a 7.5 out of 10, purely for investors with a very high risk tolerance.
Because you're taking on a lot of execution risk.
Exactly. If you are looking at Navitas, you are betting that the 800-volt architecture becomes the absolute mandatory standard across the entire AI industry.
And you are also betting that their dual GaN and SiC technology maintains its lead, and that they can scale their manufacturing fast enough to convert these massive design wins into high-margin revenue before their cash runway gets dangerously tight.
Right. There are a lot of moving parts. But the upside scenario is just as clear. They are positioned at the absolute dead center of the hardware adoption cycle.
They possess the 300 patents, the proprietary wide bandgap technology, and the direct integration with Nvidia's ecosystem.
Yeah, they have successfully transformed themselves from a consumer electronics afterthought into a basically mandatory infrastructure component for the AI revolution.
They found the most critical choke point in the fastest growing industry on Earth, and they engineered a solution.
It's honestly brilliant.
It really is. We've spent the last few years totally captivated by the brain of the AI operation.
Oh, for sure. We marvel at the large language models, the generative video, and the raw compute power of the shiny new GPUs.
Because the brain is the flashy part. It's the part we interact with directly.
Right, it makes for great headlines.
But if the incredible rise and the underlying physics of Navitas are any indication, it leaves us with something really important to think about moving forward.
What's that?
As these models grow exponentially larger, what if the true trillion-dollar battleground over the next decade isn't actually the brain of the AI, but the cardiovascular system?
The unglamorous, raw electrical grid.
Exactly.
Yeah.
The solid-state transformers, the high-voltage power infrastructure required just to keep that brain alive. Because all the compute power in the world is useless if you can't plug it in. Keep your eyes on the power.
That is a fascinating way to look at it.
Definitely something to ponder. All right, that is all the time we have for today. Remember, if you enjoyed this analysis, please subscribe, like, and comment underneath.
And don't forget to check out that VIP Algos link down in the description for top-tier market momentum tracking.
Thanks for listening, and we'll catch you next time on Smart Wealth with Joshua.